Good evening to all. Good evening, everyone. We are happy to see you. Good evening. Today we have, as usual, let me welcome you to the webinar series on performance-based strategic management accounting. And today's topic is why is traditional accounting failing managers? So I'm very happy to welcome Gary Hawkins, who's here with us today. Then we also have our distinguished invitees. We have Dr. Nuwan Gunratna, who just checked in from based in Australia.
Oh, now I'm in Sri Lanka.
Now you're back in Sri Lanka. Okay, yeah. Good. He was earlier there. Then we have our Vice President, Mr. Hennak Bandara, who is also the Vice President of SAFA. Then our council members, we have Mr. Ruchira Pereira and Mr. Gajendra. And I've also have a very special invitee today, Mr. Tyrell Roche, who's very much involved with the Cost and Management Accounting Standards Board, and he will also help us in the moderation of the session. Let me also welcome all our participants. We have our members. We also have a number of our friends from the South Asian region who are here with us. Then also the other invitees and friends from the corporate sector. So as I told you today, we are back again with Mr. Gary Hawkins, who's very well known to you. I think I have been introducing him many times. And this is the he's been doing a number of seminars for us on the performance-based strategic management accounting, and also to instill in all of you the importance of cost and management accounting. Because as you know, Sri Lanka, we have been more based on the financial accounting area, but if we can make use of cost and management accounting, it will really help, especially in this pandemic, where cost is very, very important. Expenditure is also another area, and of course, how one could match your revenue with the expenditure. And today, even some of the major problems that we are facing are really some things that are really involved with the debt management, and also with maybe the expenditure not matching the income. We have our imports exceeding the exports. So what is the solution that we are going to have for these sort of matters that are concerned? So today, I think, as I told you, there have been a number of series of seminars we had. First starting with the strategic cost management, then we're going on to lean accounting, which I know that most of the companies are today practicing with the pandemic that we have. In the predictive accounting, customer profitability, and today, why is traditional accounting failing managers? So I'm sure he will be able to explain to us in very, very simple accounting and business language as to what we need to do and how the cost and management accounting profession, the various techniques that we have, because I know in almost all our seminars, he's been talking to us on activity-based costing. I know that this is a favorite topic of his. He's written many books on this, so I'm sure that this time too, he would cover this. I, on this occasion, want to make a very special mention of something, some special award that Gary got. You know, he is a distinguished member. He received the Distinguished Member Award from the Institute of Management Accountants of USA, and this was, and he was one of the first two individuals to receive this at the inaugural Distinguished Member Awards for Institute of Management Accountants USA. And the other recipient was the prestigious Denny Beresford, who served 10 years as chairman of the USA's Financial Accounting Standards Board, or the FASB. He was a senior partner of Ernst & Young, and for Gary, this was a double honor to be equated to someone as prominent as Mr. Beresford. So I think this was a crowning achievement in his career. So Gary, I thought I should make special mention of this because I had not been mentioning this earlier, but this crowning of achievement in your career, I think your very many achievements. Of course, CMA Sri Lanka gave you the fellowship of our institute. I'm sure you will value that also, because we are very proud to have you as one of our fellow members of the institute. So let me now welcome you, invite you to make your presentation. I'm sure that you've been with us many times, and this time too, that you will instill the importance of the cost and management accounting into our many members and executives and managers who are both in the accounting and management field. Over to you, Gary.
Well, thank you very much, Lakshman. It's a privilege to present. I think this is my 6th presentation for the ICMA of Sri Lanka, and I appreciate you mentioning the Distinguished Member Award. At that time, there were 80,000 members, and I was 2 of 80,000, so it was quite an honor. The IMA is now up to 140,000 members, so I think that's an indirect indicator of the interest in management accounting. There's my email address. Any of the attendees care to directly communicate with me that way, and you're welcome to invite me in LinkedIn. If you do, though, please put the optional message so I know who you are and why you're presenting me. I do want to manage everyone's expectations. This presentation is going to be quite redundant of many of the content of my previous 5 presentations. So if you say, well, I saw those slides again, you are seeing the slides again, some of them maybe for the 3rd time. But I believe that reinforcement is a good thing. Hear about it again and again. My very first one was in December of 2020. And of course, I'm advocating put these methods in. So if you listen to them and you did not implement it at your company yet, or if you're a consulting firm or CPA firm for your clients, kind of like, well, get going, don't just keep listening to me talk about it, take action. So let's get going. Whoop. There we go. So for those of you who have not attended my previous one, a little bit about who I am. I received my industrial engineering degree in operations research from Cornell University in 1971 and my MBA from Northwestern University Kellogg School of Management. If you're doing the math, I am 72 years old, but I feel like I'm 42 years old. My career was in what I consider to be 3/3. My first decade was in industry, age 27, a division controller. Then 15 years in consulting with Deloitte, KPMG, and then Electronic Data Systems, which is now part of Hewlett Packard. And then up to 8 years ago, I was 16 years with SAS. Many of you do not recognize SAS. It's actually the world's largest privately owned software vendor, 15,000 employees in Raleigh, North Carolina, where I reside. And they specialize in analytics. I'm a native of Chicago. Go Cubs, go Bears. And many of you don't recognize those, but you do recognize Michael Jordan of the Chicago Bulls. So let's go. Who will benefit from this presentation? Managers who have previously struggled at promoting strategic cost management, financial planning and analysis, activity-based costing, and integrating business analytics into their decision support systems. Managers who intend to champion any or all of these improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is because it's been my observation that although it's nice for senior executives to sponsor new ideas and innovation, often they are preoccupied with short-term priorities and firefighting. It's typically managers 1, 2, 3 levels down in the organization chart who kind of have passion and ask themselves, how long do I want my organization to continue to perpetuate stale and arcane and flawed accounting methods? And they're the ones that will do a proof of concept or a pilot to demonstrate to their fellow line managers and their executives and board members, this is the way to go. So if you're many levels down in the organization chart, that's fine. I like talking to you. I like to always start with these three questions. What, so what, then what? So imagine that you implement the methods that I'll be describing in the next 60 minutes or so. I say, celebrate for one day. You are not done. You and your organization will see a lot more information that you've ever seen before. And that brings in the question, what's relevant? The so what? But arguably, the third question is more important. Then what? Because all decisions only impact the future. Things like budgeting, what if scenario analysis, make versus buy decisions, and the like. And during my presentation, we'll talk about what I call the predictive view, not the descriptive view. The descriptive view, last month, last quarter, looking through the rear view mirror of the car. The predictive view is the future through the windshield. So this presentation is actually drawn from an 8-hour seminar that I do, but I'm going to focus on these 4, 5, and 6 items of the one-day workshop. Also, part of this is actually going to be drawn from a 2-part article series I wrote for the Institute of Management Accountants Strategic Finance magazine. I was also honored later to be, after I retired, a voluntary unpaid role executive in residence. I was in that role for 3 years with the IMA. I do want to add, how come I'm pretty good at activity-based costing? Well, careers have a lot to do with luck and circumstances than being smart and competent. And in 1988, KPMG struck a contract with Harvard Business School professor Robert S. Kaplan to train consultants on ABC. He wanted more qualified consultants, so I got recruited from Deloitte. There's a photograph of Bob Kaplan. I know him very well. And his big breakthrough book that really kind of made awareness of the problems, the why is traditional accounting failing, was in the 1970s, Relevance Lost, the rise and fall of management accounting. And of course, I came through and authored several books. I'm not advocating you purchase my books. If you just go to Wiley, chapter 1 is a free download. It's pretty good to give you an overview. I do want to start, though, with a taxonomy diagram, like in biology, plant kingdoms, animal kingdoms, that I created for the International Federation of Accountants. You may not be familiar with IFAC. That's their acronym, IFAC.org. They're like the United Nations of accounting institutes, I believe like 180 institutes. And I told them I could create this taxonomy. So let me briefly describe it. The 3 kingdoms are tax accounting, financial accounting, management accounting. Now I want to clarify, all costs are calculated. That's why you see from the management accounting, it's got cost measurement. Expenses and costs are not the same thing. Expenses are when the organization exchanges money with third parties, pays suppliers, or pays employees, payroll. Currency exits the treasury, like writing a check. All costs are calculated, process cost, product cost. So let me just lay this out. So after the costs are calculated, if you go to external financial reporting, then you follow regulatory agency rules. We call them GAAP, generally accepted accounting principles, things like inventory valuation and cost of goods sold. For management accounting, it's about cost reporting and analysis. But again, it's still the descriptive view. But then when we go to the predictive view, now we're talking about decision support and cost planning. And some of the chartered accountants are not particularly happy with me when they look at the spectrum of value at the bottom of this diagram. Notice that to the far left is low value add. Then we move to the middle, modest value add, and then far to the right, high value add. The value of accounting increases as you go from regulatory reporting, which is primarily valuation, to the next 2, which is creating value for shareholders and owners. So let's start with the strategic managerial accounting. What's caused interest? This is one of the many reasons there's interest in corporate performance management. It's mistrust of the managerial accounting system and its flawed cost allocations and misleading cost reporting of outputs, products, standard service lines, channels, customers, and outcomes. Here's part of the problem. This is somewhat intended to be funny. The vertical axis is the math skill. that a person acquires. And the horizontal axis is, where you are in life. So when you're a little child, you count numbers on your fingers, elementary school, addition, subtraction, multiplication, oh, now we're getting to geometry. Oh, now we're getting fancier algebra, trigonomic, a sophisticated calculus. And now you're in your job, boom, back to spreadsheets. We got to use advanced analytics more. So here's a primer on management accounting and direct costing versus indirect costing. The highest, first the diagram is you always start with the resource expenses. You translate them into the activity and process costs, and then you reassign them at the very bottom to what we call final cost objects. The highest form of direct costing is project accounting or work order costing, but it only applies when there's non-repeatable processes and it's a unique product or a make to order or engineer in manufacturing. Many organizations then do standard costing. And I want to manage people's expectations that are in the service industries. In the United States, only 8 out of every 100 jobs make products. The others are services, banks, insurance companies. It's not a tangible product. Everything I'm going to describe here is universal. So don't think, Gary's talking just about manufacturing. I don't want to pay attention. No, this applies to you too. Activity-based cost management, the next one over, I call it the poor person's standard costing system. It's actually simpler to do. You may think it's more difficult to do. But the real message of this slide is look at the right, allocations with a line. Allocations are bad. I will distinguish the difference between allocating and tracing and assigning expenses. And let me do it this way with the simple definition of activity-based costing. Imagine you go to a restaurant with 3 other friends. You order a little salad and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair. This is not equitable. I ordered a little thing and they want me to subsidize them by splitting it evenly. So, and if you were to, and that's how products and service lines feel in a general ledger standard cost accounting system, when the accountants take this large amount of indirect expense, commonly called overhead, and they allocate it like spreading butter across bread using factors like number of labor hours or number of units produced or sales amount or square feet or square meters or number of employees per cost center and so forth. None of those factors reflect the unique consumption that those products and services consumed of the end-to-end business processes and the work activities that belong to them that are drawing on the expenses. So if you were to decompose and subdivide those indirect cost pools and then trace each of them to the outputs using a driver, a cause and effect relationship driver, you will discover, compared to that butter spreading, some of the products and services in reality are overcosted and the others must be undercosted because it's a zero-sum error game. And that means with the butter spreading, the accountants are providing flawed and misleading information to their line managers. It's really irresponsible. So the simple definition of activity-based costing is as if the waiter or waitress brings 4 individual checks to each of the diners. You only pay for what you consumed. Now, the reason there's been interest in ABC over the last, if you will, 70 years is, hold on one second, has to do with this diagram. It shows the 3 universal components of any organization's expense and cost structure. At the bottom, the direct or the recurring labor, the material, and then the overhead indirect expenses. And when you ask people, why is the indirect displacing the direct over time? They say, well, computers, machinery, automation, we're automating the frontline workers. That is secondary. The primary reason for the displacement is over time, all organizations have had an increased proliferation of different product types of products and services. Manufacturers, more colors, more sizes, more ranges. Banks, more types of depository accounts. Insurance companies, more types of policies. The point is this: whenever you increase the diversity and variation of the outputs, it just produces complexity. And the complexity requires more and more indirect expense to manage it. So 50 years ago, when it was homogeneous products and services, most of it was direct. Didn't matter if you butter spread the little sliver of indirect, but today it's so much larger that you need to trace and assign it. Now, the problem actually begins with this traditional responsibility cost center statement. Every manager on the planet Earth recognizes this statement, salary, equipment, travel. But the problem is, when managers get this kind of report, they're either happy or sad, but they're rarely any smarter. And it doesn't mean the report's a bad report. No, the report's a good report for its purpose. It's just that the data in it is structurally deficient. It's not structured in a way that can make them smarter. So notice what activity-based costing does. It restructures the same $914,000 into the middle, which is the language of work: key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. It's the same amount of money. And then it reassigns the same $914,000 into the products, services, channels, and customers, just like the waiter or waitress in the restaurant, based on a cause and effect relationship. Now, I've rotated the previous slide 90 degrees to the left. It's not quite as simple as, just take our ledger expenses, convert them into these work activities, and then somehow assign them to objects. The right diagram is far more reflective in reality, because you have support departments that support other support departments that ultimately support the, if you will, the frontline departments that interact with customers or make products. So it must be a multiple stage cost assignment network. And I want to warn you, the next slide is going to look very complex. I'll just spend a couple minutes on it, but you can go to the IMA website, imanet.org, search on my name. There'll be a statement of management accounting called Implementing Activity-Based Costing. It's 30 pages, and it will describe the next 10 to 15 slides. But here it is. It's not as complex as you think. It has those three universal components of anybody's expense and cost structure. The resource expenses at the top, that's from the ledger. We get the transactions from payroll systems. The work activities that are in the middle, and then they eventually pile up at the bottom into the products, services, customers, business sustaining. Now, you need to adjust your thinking here. This is not a process flow chart with swim lanes end to end. It is a reassignment network. So if this organization spent 2 million euros, dollars, rupees, it will be the exact same 2 million of work activities. It will pile up exact 2 million to the bottom two right boxes, customers and business sustaining. I'll describe what those are in a second. Think of the arrows as thin straws or wide pipes, where the diameter reflects the amount of money flowing through. That's why the 2 million reconciles exactly to the bottom. Now, business sustaining is a special category. There will be some expenses that have nothing to do with making products or interacting with customers, things like the legal department. So we create a final cost object like senior management or board members or regulatory agencies to trace the money there. That way we will not be over costing products or customers that had nothing to do with that. It's typically about 10% of spending, so you still need to recover that with price to be profitable. It's just not traceable to products or customers. Notice I also have people activities and equipment activities in the middle. Men and women run machines, machines make products. Men and women drive buses, buses deliver passengers. So assets also do activities. And notice there's a couple of boxes there that has the cost to serve. Notice they're not going to the product, they're going directly to the customer. I'll come back to that later when we talk about customer profitability reporting. Direct cost, it is not broken. You may have data integrity problems with your systems, but you can fix those. Now, what is the consequence when you do ABC? What this diagram is showing is the vertical axis is the amount of error distortion from when you do activity-based costing compared to the traditional butter spreading. So the horizontal line, if you see the bottom one, that would be the traditional costing, you know, the butter spreading. But when you do ABC, you'll discover that the simple products are the ones where are actually hidden profit. You know, they've been overcosted. That's like you in the restaurant with the salad. And then that curvy line goes to the top. It says, well, these low volume, more complex products actually require a lot more indirect, but we're butter spreading it. So the magnitude of the error is not 10 or 15%. It can be 50 to 100%. This is far more important. What does one see after you've done ABC? And you're looking at real data from a real company. The vertical axis is the net revenues minus the properly calculated and traced ABC costs through the multi-stage cost assignment network. The horizontal axis is the cumulative buildup of profit, but it is rank ordered, starting with the very most profitable product, the second most profitable product, and so forth. So with this company, this was actually a folding chair company. They had almost 900 products. It's always organization shock when managers see this graph. It's commonly called the humpback whale curve, whale curves, because look, it looks like a whale. Why are they shocked? In this case, it said, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products. You lost $6 million on the remainder to net out a 2. They usually cannot believe it. But when you show them the system, they can't argue with it. The very last data point, 2 million, will exactly reconcile with the profit and loss. In this case, it was 30 million quarterly revenue, 28 in expense, 2. Problem is the belief system of the team, the company, is it was this little blue line, you know, kind of like, all right, went up a little slope, oh, a few unprofitable products. What's happening is the multi-stage cost assignment network was detecting all that diversity and variation, colors, sizes, ranges, and reflecting it to be the top line. So the blue line is false, the top line is the truth. Now, some of you may be asking, well, what does one do with all of those unprofitable products to the right? Do you drop them and abandon them? No, that could be a mistake, because some companies deliberately have some products that are priced under their cost. We call them loss leaders because they are associated with profitable ones on the left. Blades and razors for men's shaving is a good example, okay? Also, you may think, you know, what do I do with this stuff, with these unprofitable products? You know, just hang on to them. But the point is this, at least the top line is fact-based data. At least the top line is fact-based data. And remember this, in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss of the boss of the boss. So to the degree they're relying on gut feel or intuition or flawed and misleading information like the blue line, the organization is at risk. Now, there's more here that meets the eye in that diagram. If you looked at any one of those data points, what each product is doing is it's reaching up into the work activities and asking how much of each of you did I uniquely consume? And it piles them up like pancakes, where each of those pancakes is the quantity of the driver times the unit level cost consumption rate. We'll come back to that later. So now we get the visibility and transparency that is missing with that hidden cost of the overhead butter spreading. This also gives information to operational people, because if they can lower the intensity or frequency of any of those arrows coming in, the stack will go down. I also want to mention the previous diagram, which looks so kind of crummy. That was my very first ABC implementation in 1988, almost 40 years ago. So it's been around for a long time. So I love this cartoon. You've got this signboard. It says answers. The path to the left says simple but wrong. The path to the right says complex but correct. Look how you CFOs are taking the right path, which is the correct path. And also to the left, the butter spreading, which I presume many of you are already doing, they're falling off the cliff, meaning they're going bankrupt. When you've got bad information, you're going to be making bad decisions. Now, let's start talking about other methods that you may have heard of. One is lean accounting. And if you are interested in an article a paper I've written on this, there is a link to it. It was in Cost Management. It's a journal. But what I want to point out is that lean accounting and activity-based costing and other methods can coexist. You can have two or more management accounting systems, different types of costs for different purposes for different users. So let me quickly describe what lean accounting is all about. This is a simplistic higher view of the multi-stage cost assignment network. Notice in the departments, each of the little X's is an activity. And then we reassign them into the final cost object, suppliers, products, order, types of orders, customer. That gives us profitability reporting. But with the same X's, we can string them like pearls end to end and now get a process view of the same activities that are also basically giving us the output view. So that then can basically be put into, if you will, what's called value stream maps. The lean management community, you may know who those are. Those people want cycle time reduction, quality improvement. They now can get a visual of those swim lanes of the processes. And then the stack is the amount of money. They can tag or score them with what are called attributes like value added or non-value added. I'll talk about that a little bit later. So ABC also provides the unit cost of outputs for cost visibility and benchmarking. Now, I want to mention something about a lot of people's beliefs about that ABC doesn't work. When the CFOs allocate, notice in quotes, those indirect expenses overhead to the products and standard lines, they spread it like butter across bread, as I mentioned. But what the CFOs are doing is they're violating cost accounting's universal causality principle. You know, rules are many, principles are few. Principles like speed of light, gravity, you can't violate gravity. It's universal. Activity-based costing resolves this by tracing and assigning the expenses based on the cause and effect relationships for how products consume work activities, which in turn consume expenses. Now, some of you may be saying, you know, Gary is starting to persuade me, maybe we should be doing activity-based costing at our organization, or if you're a CPA firm or consulting firm, some of my clients, but you say to yourself, oh, but it'd be too complicated. It'd be a mudslide of data. Every employee would have to fill out timesheets, and employees hate timesheets. There'd be 3,000 activities. It'd be huge. The IT department would have to extract these drivers from our transactional systems, and so on and so forth. Those are all misconceptions, but I can understand you would think that. But that was a problem many years ago because as a result, the models and systems were way too large, way too big, too complex, that they basically abandoned them. I came up several years ago with an alternative way to implement ABC in 2 to 3 weeks. It's based on rapid prototyping with iterative remodeling. Look at the database Zero, Model Zero. It's a workshop, 1 day, get 5 or 6 cross-functional employees into a room, quickly build a high-level ABC model. Its purpose is not to provide any usable information, just to basically show how you can take the expenses all the way to the cost for the year. Day 2, bring in the line managers, the executives, maybe some board members, the 5 or 6 people, show it to them, the light bulbs go on with everybody. Oh, that's how we get rid of the butter spreading. Oh, that's how we could validate our pricing and understand our profit margins. Oh, that's how we could do benchmarking with apples and apples, not apples to Oreos. Oh, they get it. It's accelerated learning. And then you can continue the journey for 2-3 weeks, couple of iterations, decompose some of the activities, bring in some drivers to replace the percentages. You've got a permanent, repeatable production system. Make your mistakes early and often, not later when the system is too hard to change. And I can train any of you, have this knowledge how to do this workshop and complete the task in 3 weeks if you send me an email. The reason rapid prototyping works has to do with this diagram. The vertical axis is the accuracy of what you might want to know, like your product costs or your service line costs. The horizontal axis is the administrative effort to collect the data, validate the data, calculate the data, report the data. Notice you'll get an asymptotic curve that starts going up quickly, then levels off, diminishing returns on extra accuracy for the extra level of effort of work. Well, with the rapid prototyping, you get this big, thick black slope. Notice the slope goes up very, very fast, hits the elbow, and then starts to the right. And the point is, stop when it's good enough at 95% accuracy. You know, what's confusing to many accountants is what is the primary determinant that influences that slope? It's the multi-stage cost assignment network. It was that piping diagram I showed you 5 or 6 slides earlier. If you get the relationships correct, then you will get far more accuracy. And so stop at 95%. You know, this is management accounting. This is not external regulatory reporting. Yes, on external regulatory reporting for the government, if you get those numbers wrong, you go to jail. But if you get the management accounting numbers wrong, you don't go to jail. So, you know, just get it good enough so that managers can start making better decisions. Is the higher climb worth the better view? Benefits from rapid prototyping, accelerated learning, people get it. Solving the thorny leveling problem. Again, and before ABC, they go, well, how many activities? 1,000, 2,000. Typical ABC models have 50 to 70 activities. It prevents that over-engineering, which led to why ABC failed in the 1980s and 90s. People stopped doing it. It was too big, too complex. They couldn't maintain it. Peer group, this is important. And that second day of the Model Zero, at the end of the meeting, I asked each person in the room, when this system is complete in 3 weeks, what decisions will you make with it? Oh, I'll do price validation. Oh, I'll do benchmarking. We're getting them to commit that they will use the information when we build it. It just replaces all their misconceptions with reality. So let's move on. Let's now go on to what I call fairly strategic view, the shift from being product-centric to customer-centric. The value of a company is a function of the value of its customers. The only value a company will ever create is the value that comes from its customers, the current ones and the new ones acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like the ones you have now. But we have a couple of problems. The CFO is not calculating customer profitability. They're stopping partway, just at the gross product profit margin line. They need to go further. So let's talk about this. What about all the below the line calculated costs? Products and standard service lines are not the only thing for which accountants should compute costs for. What about all the costs that have nothing to do with making products and delivering standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. You know, what's below the gross profit margin line: selling expense, marketing expense, distribution expense, customer service expense. I'm going to make a case why that bottom half is more important for the top half. But before I do, I neglected to insert a slide. Those of you who may be in public sector government and saying, this has got nothing to do with me. I neglected to put in a slide. I recently co-authored a book, and if you go to wiley.com, W-I-L-E-Y, its title is Value-Based Management in Government. And it's all about public sector. All of these methods can be applied for government agencies, just like for companies. Let's continue on. Visually, what I'm describing is if the entire rectangle in this picture is the expenses for the month or the quarter, the shaded part is only for the product or service lines. And it'd be nice if those indirect expenses were assigned and traced using ABC. But look at the white one, white space, distribution, sales, marketing, general accounting. I'm now going to make a case why the white space is more important. Management accounting must help the sales and marketing functions. Company needs to know the best types of products, channels, and customers to retain, grow, win back, and acquire. So let's talk about this. Why is the bottom half more important than the top half? Here are 4 reasons about customers. Customer retention. It is relatively much more expensive to acquire a new customer than to retain an existing one. Well, that's kind of a no-brainer. Here's why. All, if you will, acquisitions are in the future, but existing customers, you already have them. So they're a sunk cost. And if you know about decision theory, when you do evaluation for decisions in the future, you do not include sunk or fixed cost. You know, in your textbooks, the relevant range. Number 2, sources of a competitive advantage. As products and standard service lines become commodity-like, then the shift is towards service differentiation. So what do I mean? You know, here's the point. Customers are the source of value creation for shareholders. And most customers view suppliers as commodities. They all sell the same stuff in a way. Banks have the same depository accounts. Therefore, for a supplier to be competitive, they need to provide differentiated services to different segments of customers. Not all of them are doing it well. Number 3, CRM, customer relationship management, one-to-one marketing. Pepper and Rogers, this is Don Pepper, Martha Rogers. They are gurus in the marketing world. They have hailed technology as the enabler to, 1, identify these customer segments, and then tailor the marketing offers, meaning work backwards, knowing the unique traits, preferences, and likes of customers, and offer them price discounts, coupons, deals, offers to entice them to buy more. And then finally, 4, the power shift. The internet is shifting power irreversibly from sellers to buyers. And I don't mean you and your household with your family buying things on the internet. Today, a purchasing agent in a company with a click of a mouse can see 10 suppliers and all of the information about that. And this internet, this is a one-time event happening in our lifetime. So if you take these 4 forces, and there's probably a bunch more, it's saying we need to know much more about customer behavior. And then we've got this problem, angel customers and demon customers. You know, what do I mean by that? Every company has high and low maintenance customers. Example of a high maintenance customer, always changing the delivery schedules, always demanding special, not standard product, always returning goods, always calling help desks. Low maintenance customers, the angels, you love them. You know, never change schedule, never only buy standard, never call help desk, never return goods. If those 2 types of customers bought the same volume at the same mix at the same price, they're not equally profitable because the high maintenance one is causing you so much extra work and cost. But what really caught my attention about this book is not the main title, but the subtitle. Discover which type of customer is which and turbocharge your stock price. And that gives us that connection from customer value creation to shareholder and owner wealth creation. Another message is sales volume is not equivalent to the profit level of a customer. Now, I'm not going to go through this decomposition of the multiple stage cost assignment network. This is one of the figures that's in that 30-page Institute of Management Accounting, Statement of Management Accounting article, I mentioned implementing ABC. But you'll see that the activities in the middle from left to right are being traced into the bottom, which is really like the predator food chain, like large mammals eat small mammals eat plants. When you're in the final cost object, they will eventually, again, pile up into the customers. But as you go from left to right, there is basically layer by layer, less cost. This then gives you a profit and loss statement for each individual customer. And you'll notice that there are layers of margins revealed and now visible like an onion skin. And in this fictitious example, notice there was a 30% composite gross profit margin for the products that this company bought. But between the 30 and the 8, 22 more points of margin are eroded, nothing to do with making the products, but all with, if you will, selling and distribution. So if you calculate a P&L for each customer and just take those 2 data points, you can put them onto a grid that looks like this, where each customer is the circle intersection in the grid. The vertical axis is the product mix gross profit margin. This is above the line. The horizontal axis is that cost to serve, from those angels on the left, low maintenance, to the devils on the right. And now things become obvious. The most unprofitable customers are in the bottom right because they're purchasing low profit margin mix from you and they're difficult to serve. Those profitable ones are in the upper left because they're buying high margin mix from you and they're easy to serve. And now the name of the game is move the dots from the bottom right to the upper left, make them customers more profitable to you. And Lakshman and the others, this would be a seminar by someone else, not me. That would be marketing people, not management accounting people. But what those marketing people would give you examples to move the dots would be, well, do unbundle and fee-based, charge individual fees for those extra expenses. The airlines have been doing that for quite a while with baggage, and even you have to buy a middle seat get out of a middle seat on an airplane. Banks with depository accounts. Something that is relatively new, at least I'm seeing in the United States, is that the sales director, when they sit with their sales force and they examine the commission incentive system, which is typically 100% sales volume, they say, no, we're now going to make it a blend. I'm going to hold you accountable for each customer. I'm going to measure you on 60% sales, 40% profit of your customer. And this motivates the salespersons to figure out ways to alter the behavior of the customer in harmony with the expense structure. For example, let's say you're a salesperson selling to drugstores, delivering 7 days a week, but with partial truckloads and partial skids. And you go to the store manager of each store and you say, can I deliver to you Monday, Wednesday, Friday, 3 days, not 7 days, but I know it will be full skids and full truckloads, which is much more economical. I now alter the behavior of the customer in harmony with my expense structure and made it more profitable to us. This diagram, circles are now squares. It's still, each square is a customer. The vertical axis is how profitable the customer is. The horizontal is now the sales volume. Don't notice the square to the farthest right is the largest sales customer. Above that, though, is less sales, more profitable. But look at the triangle in the bottom. There's a whole bunch of customers, pretty significant sales, unprofitable. The message is sales volume is not equivalent to customer profitability. So what's really needed is a shift in the CFO's emphasis. Typically, the CFO, to simplify, pound on operations to get their costs down and give reports to the board of directors and executives. You need to do a third thing, help sales and marketing to better target customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits. This means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or win back, and which types of customers are not attractive. And then comes the question for those that are attractive, how much should we optimally spend attracting, retaining, growing, or recovering each customer microsegment? And notice I have optimally in quotes in italics. Why? It is an optimization problem. Because remember the book, and incidentally, the book was authored by marketing faculty at Columbia University, so it doesn't have a lot on cost accounting. But remember the subtitle to the book? Discover which type of customer is which turbocharger stock price. Here's the message. For each segment, customer segment, and the marketing people can segment customers, not just four squares, old, young, male, female. They may have 15, 20 different types of segments. You can destroy shareholder wealth in two ways. You can destroy it by overspending unnecessarily on loyal customers for what is needed to retain them. You know, you spend a lot of time whining and dining them, they were going to buy the same volume and mix regardless. But you can also destroy shareholder wealth by underspending on marginally loyal customers and risk their defection to a competitor. So for each segment, there's an amount that's not too high, not too low. Therefore, what is the optimum spending level for differentiated services to different micro segments of customers? Only the accounting department can provide this kind of information to the sales and marketing team to basically help them, facilitate them in making these better decisions. If you are involved with supply chain, very briefly, just a couple months ago, I co-authored a book with two professors from the University of North Texas. Its title is Supply Chain Costing and Performance Measurement. There's a link to it at the bottom if you're interested. Let's move on. Operational, how to basically now get to the process costs. This is less strategic, more operational. One technique with activity-based costing is you can tag each individual activity, especially when you use commercial ABC software, with what's called an attribute. There's actually many attributes. And one of them could be this, you go through this series. First question, is the activity required by a customer? If not, can we stop doing it? But if it is, can the frequency be reduced? Like my example of delivering to the drugstore instead of 7 days a week, 3 days a week. We saved money. We didn't have to do the other 4 days, and it was efficient each time. Then comes this value add. Is it high value add or low value add? And that gets pretty ambiguous, but it is a way to do it. Finally, let's move on to the predictive view. Remember my what, so what, then what? Now the issue is, what's the problem with budgeting? The budget is broken. The budget is typically a fiscal exercise done by the accountants that's disconnected from the executive team strategy, and it's not based on future driver volumes. It's driver insensitive. You know, typically, how do organizations often do the budget? See if you can relate to this. You give every cost center manager a spreadsheet, January to December. Every line item of their expense accounts, including rubber bands and paper clips. They put in numbers in the spreadsheet from January to December. When they're done, someone in the accounting department has to consolidate all those spreadsheets. They do that, they bring in the forecast of the revenues till they get to the profit. You give it to the executive team. They look at the number, they say, well, that's okay, but not good enough. I need more profit. You send all the spreadsheets back to the managers. They lower some of the expenses in some of their accounts. Someone consolidates it, you give it back to executives. That's better, but not good enough. Up, down, up, down, up, down, up, down, up, down. You almost want the executives to answer, what number did you want in the first place? But that would tell us what the executive's aspiration is for profit. We want to get reality. So how can we get to, and here's some other problems with the budgeting. See how many of these apply to you. You'll probably laugh. It's invasive and time consuming with few benefits. It takes 14 months from beginning to end. Well, maybe 6 months or 3 months when you start 3 months before you publish it. It requires those 2 or more executive tweaks at the end, the up, down, up, down, up, down. The budget is obsolete. It's out of date a couple of months after you publish it anyway, because so many things have happened. It can also starve the departments with truly valid needs. In the next fiscal year, there may be an increased demand coming on a department, but you only let them add a couple of employees. They needed a lot more. It caves into the loudest voice and political muscle, which is the next one. It rewards the veteran sandbaggers, people like me with gray hair, no hair, the ones that have been around for 20, 30 years. They know how to pad that budget because there's a gaming problem. Just they want cushion there just in case something goes wrong next year. Next, it incorporates last year's inefficiencies into this year's budget. The processes were inefficient and we're replicating them again, continuing into this year, next year. The last one's the one that bothers me the most. When managers are on a glide path, 3 to 4 months from the end of the fiscal year, and they realize they're not going to spend all of the budget that was allotted to them, what do they start doing? They start spending needlessly, foolishly. Why? Because they know that next year's budget is going to be pegged to a baseline of how much they spent this year. I call it spreadsheet budgeting. Here's an example of one of the department managers' projection to the end of this fiscal year. Column B. So for next year, let's say we'll give them a 5% increase for inflation. So we take, column B times 1.05 and copy down. I hope some of you are laughing. This is ridiculous. What happens if this department's going to have a significant increase in workload? They're going to need a lot more money or less, and they'll be understaffed. Or if the work is going away because we've automated some stuff, they're going to be overstaffed. So how can we replace the traditional budget with an alternative that serves the same purpose of a budget? Here's the way to view it. The amount of money to be spent in the future is a result of 2 river streams. The upper river stream is the recurring, repeatable work. It's demand driven, like customer demand, products and services they will buy. The lower river stream is non-repeatable, non-recurring work, and it will be project driven. And I will talk about 3 different types of projects: capital projects, risk mitigation projects from the enterprise risk management community, strategic projects for the strategic accomplishment. So let's drill down. For the upper river stream, the repetitive work, we always start with the expending, the resources, the process costs, the activities costs. But once we have that model calibrated, we can calculate backwards. We can forecast the volume and mix times the consumption rates to solve the level of spending. So let me describe how that works. See, to the left side, that's that descriptive view. Last year, last quarter, the spending is known exactly. With activity-based costing, we calculate the activity costs, we pile them up, we solve for the profit margins, outputs. But we get a bonus. We get unit level consumption rates. There is always going to be a unit rate, cost per material move, cost per blood test in a hospital, cost per processing an automobile loan, and so forth. Then in the predictive view, I call this Industrial Engineering 101. I think I learned it my second semester freshman year in 1967, Cornell University. Look at the equation to the left. The demand, volume, and mix, that's the forecast, times the unit level cost consumption rate equals capacity required, meaning the number and type of employees and their wages and salary level, and purchase with suppliers. So you got to think like an engineer. It's modeling. So let's go back and decompose our upper and lower river stream. For the upper river stream, we do what I just described. You forecast the volume and mix, multiplied times the unit level consumption rates. Now you know the operating expenses. For the non-recurring expense, and I didn't go into this detail in the interest of time, if you go to the Kaplan and Norton strategy map, and I talked about this in one of my earlier presentations, and you have people identify the projects and initiatives or core process and the spending on that to accomplish the strategic objectives that are in the strategy map, which its purpose is about executing the strategy, which is a frustration of most executives, connected the budget to the strategy. And risk mitigation, same thing. The risk mitigation people have a way of, if you will, determining how much does it cost to mitigate certain types of risks that are highly probable and will have a big impact. And we put them all together, add them together, we're going to get a much better number. Now, be prepared. The next diagram is a decomposition. It's not that complicated. The shaded boxes are the upper river stream, the repeatable work. The ones to the left are the 3 projects. Put your eye on the bottom box, shaded box. It says derived budget. Notice the input from the top is the operational budget. The 3 from the left, capital budget, strategy budget, risk budget. Briefly, on the upper repeatable, you can see the driver consumption rates are coming in from the top because we calibrated them from the past. Forecast volume and mix gives us number of person hours, pounds, kilograms, number of employees. That's our capacity requirements. We monetize it, euros, dollars, rupees. That's a good number. And the 3 from the left is a good number. Now, we will still encounter the same problem with traditional budgets. You give it to the executives. Do they like the number? Not enough profit. Go change something. Well, one of the temptations might be, well, let's basically eliminate or postpone some of the capital projects, strategy projects, risk projects. Bad. We don't want to do that because then we're going to expose ourselves to risk. We're not going to execute the strategy. There is one lever that you can change to lower the cost. It's the unit level consumption rates, which mean productivity improvement. So for the next fiscal year, try to get 2%, 3%, 4% productivity into the processes. And that's where lean management, Six Sigma, the process improvement people come in to play. Forecasting. Don't treat forecasting as a special event. Forecasting should be an ongoing part of monitoring the business. We haven't forecasted in a while. Maybe we should add that again. That's in the cartoon. I love that cartoon. Here's the deal with forecasts. Most forecasts become less accurate one day, 1 week, 1 month after they're created. Notice in this graph, the accuracy of the forecast is 0 to 100%. The first forecast, the curvy line, look at it. A day, week later, it's losing accuracy. But if you reforecast, let's say quarterly or monthly, we're always going to have a better number. And I am going to go back to this diagram. If you have an automated system, FP&A system, and I'm not going to name the software vendors, but they're all pretty good now. The only independent variable is the forecast of the volume. Every other variable has either been calibrated, like the unit level consumption rate, or it's been determined through judgment. So if I can keep inserting the volume and mix forecast into this calculation engine, even if you got 1,000 or 10,000 products, I'm going to get a P&L and balance sheet by month, not just to the end of the fiscal year, but out 18, 24 months. And with that, you can now get net cash flow. And I can tell you with the COVID pandemic, board of directors want to know net cash flow out 18 to 24 months. They want to know, is the company I've got governance responsibility going to need to borrow or basically get equity stock, or are we going to have surplus cash to invest? That's the key. Now, it does get tricky when you do the predictive view. Remember, what, so what? That's the descriptive. This is then what. When we do the then what, it's a little more complicated. Because when we're looking backwards, we don't need to pay attention about fixed, or variable. But in the predictive view, we need to classify the behavior of each resource's capacity as sunk unused, fixed, step fixed, or variable. And the challenge is the classification depends on the planning horizon. Because if it's short term, 1 day, 2 days, if there's not enough orders in the factory, you're not going to lay off some employees for a day and then hire them back on the next day. Of course, you're going to retain them. There'll be unused capacity for that 1 day. But as we go out weeks, months, quarters, we may replace full-time employees with temporary contractors. We may lease assets that we ordinarily may have purchased. So it becomes more variable longer term. Step fixed, in case you want to know what that is resources come in discontinuous amounts. You can't buy a half a machine. You can't hire a third of an employee. It's all or nothing. So as you add capacity, it goes in steps. Now, some of you may be interested in knowing, I wonder how good my management accounting system is. And if you're a CPA firm or a consulting firm, you may want to consider what I'm about to describe to evaluate your clients. I also created for IFAC, the one I did the taxonomy diagram, a paper for them that they asked me to do that is a stages of maturity of costing. And most organizations are typically at a lower level of maturity when I show you the diagram. Let me show it to you. I'll just briefly describe it. You can basically you can also go to my website, www.garykokens.com, download, it's a 30-page paper. On the descriptive view, there are 8 stages. I can tell you that 90+% of organizations are a 5D or lower. And I think the majority in India, Sri Lanka, and your Asian countries are a 5D or lower. You're just doing that good old standard costing and butter spreading the indirect expense. 6D is where we begin activity-based costing. 7D is when we continue and below the product gross profit margin line. So that is the key. On the right side, the predictive view, 1P is those with those spreadsheets, up, down, rather than using the basis that I described to you. I think it's important for you to know where you're at. And let me also say that if you're at a 5D, you don't have to get to 8D. You just ask, is the incremental effort basically worth, do we get incremental higher benefits for the incremental effort to go from 5D to 6D? And I showed you with rapid prototyping, you can do it in 3 weeks, not months. I love these quotes. It is better to be approximately correct than precisely inaccurate. Some of the CFOs in the manufacturing world, you do your little burden rates at machine centers and you worry, about, are they accurate? You worry about, is it correct 5 digits to the right, of the decimal point? Your problem is 2 digits to the left. And in the land of the blind, the one-eyed man is king. Once you have visibility, you can outsmart your competitors. So to begin to summarize, what's really happening, not just with management accounting, but all the corporate performance management methods, including strategy map, balanced scorecard, risk management, lean management, and the like, is there is a shift in the source of return on investment from tangible assets to intangible assets. Meaning the shift is from, buying machines or trucks or hardware to an intangible asset like information. And you'll see in this diagram, the return on investment from information increases exponentially left to right as we go from data to information, to knowledge, to insights, to those better decisions. The problem is many organizations are stuck in the first 2 red bubbles to the left. All they've got is raw data and standard reports. All they can answer is what happened. Typically that comes from ERP systems. Now the third bubble, in some cases, the chief information officer, the IT director, will give some managers what is called business intelligence drill down software. Actually, I'll name some of the vendors: Click, Tableau, Microsoft Power BI, SAS, my previous employer. So this allows managers perhaps maybe to go drill down when they see an anomaly or unfavorable variance to see an individual purchase order or invoice, what's causing that problem. But they're still limited to only answering the questions, what happened? Corporate performance management and all of its methods starts with the first blue bubble. It's about modeling. And descriptive modeling starts with last month, last quarter. Costing is modeling. Remember the multi-stage cost assignment network? That's not T accounts and journal entries. We're modeling how the expenses are consumed into the calculated cost. Those of you who attended my strategy map seminar for the ICMA, it's a map of the executive team strategy on a single page. So now we not only know what happened, we know why did it happen, because modeling requires causality principles, causality relationships. Now let's go to the predictive view. The future's coming at us, volume and mix and forecast. Now we can not only answer what happened, why did it happen, what can happen. We can calculate, we can do sensitivity analysis. We can do modeling. What if scenarios increase the forecast of volume and mix 5%, decrease it 5%, see what the impact is on the income statement, balance sheet, net cash flow, and out. Make versus buy decisions, outsourcing decisions, capital investment decisions, fixed, variable. That's where that all comes in play. You got to think like an industrial engineer. I always tell everybody I'm an engineer masquerading as an accountant, even though I was an accountant at the age 27. And then we get to the top, prescriptive analytics, which is really optimization. What that is for is, of all the choices we could make, what is the best choice? And that really gets to sophisticated analytical tools like linear programming. So here's my frustration. I'll quickly conclude, and then Lakshman, we can get some feedback from some of the attendees. Why is the adoption rate for profitability reporting with activity-based costing been so slow? Well, here are three barriers. One are technical ones. We got an IT related, though we got dirty data. Someone didn't enter the information correctly, but the IT function has a tool called extraction, transform, and load. Think of it as an app, ETL. It can purify the data. Or you may be a larger company with multiple hardware. You've got Dell equipment, you've got Hewlett-Packard equipment, you've got IBM equipment. IT can solve that. The next problem is this perception barriers are excess complexity and affordability. And I imagine that several of you who are listening to me, when I began talking about ABC, that was your perception. Oh, it's too complex. It'll take too long. It'll be too difficult to do. Employees don't want to fill out timesheets. And I demonstrated to you it can be done in 3 weeks quickly, good enough. So that's solvable. The real problem, number 3, nothing to do with technology, nothing to do with processes. It's all about people. It's organizational behavior barriers. It involves resistance to change, culture, and leadership. Let me give you some examples. Resistance to change. It's human nature. People like the status quo. Only babies like change of their diapers. Here's another one. Fear of knowing the truth, or fear of other departments knowing the truth. How about this? Fear of being measured, fear of being held accountable. Oh, I don't want anybody to know. Weak leadership. There, I said it. Not every executive team has the highest IQ. So if you really want to implement these successfully, you've got to have some change management skills. Many of you do not, but you can get them. How do I get buy-in from people? And then quickly, here are some of the excuses why people won't proceed. We are profitable, so why does it matter? You may not be profitable for long. We will purchase software that will fix our problems. Hey, the software is just a tool. A fool with a tool is still a fool. You need to know how to configure and model it. Next, we already know our true cost from our general ledger financial reporting system. No, you know your true expenses. You don't know your cost, you calculate your cost. Next, we have done it this way forever. We don't do that here. We already know everything. It is in our heads. That's pretty arrogant. Next, we are a small organization. We'll worry about better methods when we get larger. People often ask me, how large do you need to be to use these methods? I say 25 employees. If you're at 25 employees, you don't have to be 100 or 1,000 like Reliance Electric in India. You don't need to be huge. At 25, you still need to apply these methods. Next, all this hype is just made up stuff from highly paid consultants. Well, let me defend the consultants right now. The consultants are important because they have something that you don't have. They've got the ability to focus. You're preoccupied firefighting and other priorities. You don't have the time. Next, no one looks at the reports I create, so there is no point generating better reports. That's sad. Those are those of you who are actually trying to help your line managers. You try to give them better information, and they throw your report into the can. Next, we cannot afford better software to fix our problems. Actually, the ERP software, pretty expensive, but there are quite a few commercial software vendors that are low priced. Next, we are too busy doing other things. Well, one of those other things is closing the books. You take 3.5 weeks to close the books. You take a deep breath for a day, the hamster wheel spins and the next month's cycle starts. Close the books in a week or two. So you've got an extra couple of weeks to implement these. Finally, we don't know where to start or how to get started. And I've been mentioning my rapid prototyping techniques. That's the way to get started because it's so engaging because it's your own company. So the complete vision of performance management. Notice I have a cover of one of my performance management book, Greasy, Grimy Gears. That's the old way. Some of those gears are broken. Some of them are disengaged. Maybe someone threw sand into that. You know, if you put that into your car engine, what's your fuel efficiency? Low. Now the vision, titanium gears to the right, spinning faster, revolutions per minute, meshed together, you know, lubricated, digitized. Now put that in your car engine. What's your fuel efficiency? Much higher. Now replace the metaphor of fuel efficiency with rate of shareholder wealth. That's what you get when you put all these together. Make the revolutions per minute of the corporate performance management, business analytic gears spin better, faster, cheaper. You know, that's the process stuff, safer, risk management, smarter strategy map. Your success depends on how well and how fast the right information, intelligence gets to the right people. Again, you do not need to purchase my books. Don't accuse me, oh, Gary's trying to sell his book. Chapter 1 is a free download from the websites. Action steps, get educated. Thank you. You are doing that right now. Learn how to get buy-in from the others. Rapid prototyping, start small, think big. Improve the incentives. Try to figure out how to motivate people. I've got a couple of links there to some of my articles. And Lakshman, I think we now have some time for review.
Thank you. Thank you very much, Gary. I think you went through in very, very great detail, of course, change management and of course, very many important areas, theory to practice. I think that's what we are doing as professionals. So without my taking much time, as I said, we have some of our maybe experts who are here. So first, maybe they would like to maybe most probably get questions rather than maybe make any sort of comments from, so that you can explain those. So can I initially ask Dr. Nuwan? I think he's been a keen follower of what you have been doing, present for all these seminars. So Dr. Nuwan, you like to maybe pose some questions or some valid points that we can take into account?
Yes, thank you, Professor Vatawala. Let me add some perspectives from the Sri Lankan side. As you know, borrowing from Gary, reinforcement is important. So I think I have mentioned these points previously, but let me mention some of these points for the benefits of new joiners. Now, when it comes to management accounting, so many researchers have shown that the management accounting practice application is inadequate in the Sri Lankan context. I think this is, as Gary mentioned, this is the context in Sri Lanka or maybe in India or the region. So what is important here is that even these management accounting techniques are used for traditional planning and control purposes, especially like budgeting or standard costing. And especially the new management accounting techniques such as life cycle costing, then again activity-based costing, they have all been used inadequately in the private sector as well as in the public sector. So many researchers have identified the reasons as to why the management accounting practice application is low in the country. And one of the main reasons is the lack of manager awareness. I think that's where we do this training and development and capacity building on a continuous basis. So one is lack of manager awareness. Number two is overemphasis on financial accounting reports, even for internal decision making. Because even if you look at the accounting curricula of most of these degrees or the professional accounting courses, except CMA, we see that there's a lot of emphasis on financial accounting. For many of them, accounting is financial accounting. So they have largely ignored the management accounting aspect of accounting. Then the third reason is that inadequate access to information, cost information, especially because when you don't have the accounting infrastructure for the identification, then the collection and the analysis, you can't use these techniques. So that is another reason as to why management accounting techniques are inadequately used. And finally, some of these researchers mentioned that, okay, there is primitive approach to costing. As Gary mentioned, you take the direct material, direct labor, and then you add, butter spreading of overhead analysis. So these are the four reasons that they have highlighted mostly due to for the low level of management accounting application. And also, Professor Vattawala, let me quickly mention about the public sector as well. In 2013, in their seminal report of COPE, Committee on Public Enterprises, that is the committee appointed by the Parliament of Sri Lanka to examine all the public sector enterprises, they mentioned that the public sector enterprises need cost management accounting, especially to reduce the losses, then minimize waste, and also to reduce the possibilities for fraud, and also to improve transparency. So all in all, in nutshell, in Sri Lanka, the management accounting applications are less and inadequate, both in the public sector and the private sector, and also in the SME sector. So I think that's where we need these webinars, capacity building, and workshops on a continuous basis. Okay, that's from my end. Thank you.
Thank you, Dr. Nuwan. Gary, you have any comments on that?
I just want to reinforce that in India, Sri Lanka, the imbalance of excess emphasis on external reporting, crowding out internal, is irresponsible in my mind. And India, Sri Lanka, you've got to escalate the internal management accounting. But we only have 5 minutes, so who's the next speaker?
Yeah, Tiral
Yeah,
Roche.
Gary, thank you. Very, very informative presentation. You are correct. If you take the Sri Lankan context as a practicing accountant, people don't use these methods because of the leadership of the organization. They know, but they say our organization is small. We don't need to do this. We have profits. Anyway, I have two questions for you, Gary, based on this. One is, how would the new ERP systems help in this context? Now, a lot of organizations are implementing SAP, Oracle, ERP systems. How would they help in this scenario? And number two, how would management accounting standards, since we are going to build some standards through CMA in Sri Lanka, how will these standards help in this context?
First, briefly, the software vendors have improved the features and functions, so they're not the obstacle. Most of this stuff can be done. I haven't had a chance to start reviewing the standards draft that you sent, but all I can say is that will be very essential because it kind of gives, it guides you. And what's really going to be key is the standards are really principles. Remember, rules are many, principles are few. I always say speed of light, gravity, Those are universal. So we've got, and the key principle in accounting, causality, cause and effect relationship. So I've got to make sure. So let's continue on. We only have 3 minutes, but those are good remarks. Oh, let me say something about leadership. I agree. You know, I have a phrase, a leader without followers is taking a walk in the park.
Correct. Correct. That's true.
So no one's going to do the stuff if they're not. The best leaders don't have the best answers. The best leaders and executives have the best questions.
Questions, correct.
And they need to ask questions. How come, where do we make money? Which customers, you know, but most leaders, they got promoted because they had good answers in the past. Well, that's not the case today. There's too much complexity. There's too much volatility. There's too much uncertainty for them to know. They got to ask questions.
Good.
Next.
Gary, just one question. I'll read it for you. What are the methods you are suggesting to collect data relating to the cost drivers, such as number of activities, etc., in operation?
If they go to my 30-page SMA, there's just a really simple rule. Define your activity dictionary in verb, adjective, noun, grammar, like process domestic invoices. The driver then is the noun, number of domestic invoices. That data is usually extracted somewhere. The measurement is already in a computer system. So I interpreted that question as, how do you define an activity driver? But almost all activity drivers, the data exists. We got 1 minute.
Yeah, Ruchira, one question, and after that, Mr. Hennak will give the vote of thanks.
Gary, this is the question about the life cycle costing. In the sense, now you have mentioned using ABC, we can prepare a customer P&L. I just want to know post-purchase cost. What is the best way to handle post-purchase cost? Should that be covered under life cycle costing or target costing?
Post-purchase cost. I'm not exactly sure. It probably should be included, but I believe those who may have attended my customer profitability, I talk about customer lifetime value. And just real briefly, winds up being, it's a discounted cash flow equation, because consumers go through life cycles. Young girls become teenagers, teenagers become young mothers, mothers become, and as they go through that, they will buy different volume and mix, and you need to know the profit level on that. In terms of post purchases, I'm not sure I understand that, but maybe, email, but I hope that gave me a chance to describe to people customer lifetime value. It only applies B2C, business to consumer. It doesn't apply as much in B2B, business to business, in the supply chain.
Correct.
Okay, Mr. Hennak.
Ladies and gentlemen, on behalf of the CMA, I'm glad to propose this vote of thanks after a very successful seminar conducted by Mr. Gary Hawkins. As mentioned by our president in his welcome speech, Mr. Gary is not a stranger to CMA. He has become a regular speaker in our CPD programs, and he himself mentioned that this is the 6th program that he has conducted. Thank you, Gary. With that note, I would like to thank Mr. Gary, an expert on cost management and performance improvements, for your insightful and technical presentation and sharing your experiences to educate us on why is traditional accounting failing. I'm sure that the guidance provided and technical matters highlighted by him will assist all of you to enhance your knowledge and skills. Let me also thank Dr. Nuwan Gunaratne for his valuable contribution and sharing his experiences. And let me also appreciate the contribution made by Mr. Kiral Roj. Let me also thank our President, Professor Lakshman Vatavale, for organizing this seminar under the CPD program to improve the knowledge of our members and others. Finally, I would like to thank our council members, members of the Institute and others for your participation, and the CMA team for the support extended to conduct this event. Thank you. Take care. Stay safe.
Thank you. Bye. Good night.
Thank you. Thank you. Good night.
Thank you, Gary. Thank you. I think we will hope to see you soon. So maybe we'll just look at our cost accounting framework, maybe if you have a little time, And Tiral is really wanting to connect with you on this matter. So thank you. And wish you all the very best. And I'm sure today, although we are now finishing the day, you are starting the day. So we wish you a very, very maybe successful and good day for you. Okay, Gary, thank you. Bye.
Okay, bye. Good night.
Thank you,
Bye
Gary.
and
Thank
good
you.
night.
Bye.
Thank you, everyone. Thank you,
Thanks,
Doctor.
Sridhar.
Good
Thanks.
night.
Thank
Thank
you,
you.
Professor.
Thanks, Ennaker.
Good
Thanks,
night.
thanks, Nuan. Nuan, we need to get in touch. Okay, now that
Yes.
you're back. Okay, right. Okay, right. Thank you. Okay.